Most people have no idea how life insurance truly works and how it was truly designed to work. It's not just about providing wealth to your family when you pass and leaving a legacy for your children. It's about using it while you're alive, but you have to use it the right way. Now, most people will tell you that you need a term policy, which is like automobile insurance. When you have a term policy, you're renting a death benefit, and it's almost like you're hoping that you die during the term that you purchase the policy. Because if you don't, like car insurance, if you don't get in an accident during the year, it resets at the end of the year and you got to pay again. And if you don't pay it and you get in an accident a day after it lapses, no matter how much money you gave the insurance company, you don't get jack shit. That's term insurance. IULs are tied to the stock market, meaning you can lose all your gains. Whole life is the way to go, folks. You need to have a whole life policy with a mutual company that pays dividends, because then you can insure your paycheck. What do I mean by that? Every time you earn income, rather than giving that money to the cell phone company, the gas company, the energy company, your mortgage company, and giving away all the hours that it took you to earn that money, you take that money and you purchase cash value life insurance. Now, when you do that, you get cash value, you get death benefit, and you get the ability to borrow against the policy, which means you can go to the insurance carrier, you can leverage your principal as the collateral to borrow today from your death benefit. What does that mean? That means you can run large amounts of money through these policies if you have a proper trust that can own it without becoming a modified endowment contract and having to pay capital gains tax. But when it is structured properly, you can run massive amounts of money through these policies, creating huge death benefits, and then you borrow against that through a policy loan so that you can continue paying your bills, funding your investments, and scaling your businesses. This is the way that the wealthy people use cash value life insurance, but you need to know how to do it right, and it needs to be structured properly. And I will tell you right now that probably 90% of the people out there talking about this have no idea how to structure it the right way. It has to be owned by a non-grantor, irrevocable spendthrift trust so that you can run that money through there, because the trust can own a business, meaning you can defer taxes. You can now run that money through the policy, and then you can borrow it back out and continue deploying it to build more wealth. If you want to learn more about these concepts, click the link in my bio, download all of my books at liveiws.com. And as always, from Bali, love you all.